Hi, everybody. I'm Brittany Lewis with Forbes Breaking News. Joining me now is my colleague, fellow breaking news reporter, Derek Saul. Derek, thanks so much for coming on in.
Excited to be here.
I want to talk about WeWork, which just recently filed for bankruptcy earlier this week, and they took quite the plunge. In 2019, they had a valuation of $47 billion with a B. Today, that stands at less than $50 million with an M. Tell us what happened.
Yeah, so I think, honestly, more than anything else, it's a classic story of a company that's burning through cash faster than they were making it. It's a more challenging environment for all companies relying on debt financing with higher interest rates now. We've seen the Federal Reserve raise the target interest rates from near zero in the early days of the pandemic to over 5%. And that specifically hurts commercial real estate market as well, which WeWork was obviously a part of. But before all of that happened, WeWork was losing billions of dollars when it first went public. And I think it's just a classic story of when you are a company that's cash flow negative, investors need to be really bought into your vision for being able to have pretty exponential growth, and people were not bought in.
Can you talk about that a little bit more? Because obviously work has been transformed since 2020, since the beginning of the pandemic, and this would seem like a perfect time for a company like WeWork to really sweep on in. That wasn't the case. So what were the problems with the company before the pandemic?
Yeah, so their founder, Adam Neumann, who is still a billionaire despite WeWork's demise, but I mean, this was very well documented. I think there's both Apple TV and Hulu shows on the rise of WeWork. But again, it was the cult-like personality of the founder who got a lot of people to buy into the concept that, you know, there could be this meteoric growth. And again, I mean, WeWork was just not able to capitalize. I mean, just, you know, sales were fairly flat and just losing lots of money because, as you saw with WeWork, they were, you know, capitalizing on it's almost like a spirit Halloween where it's like, you know, you're capitalizing on these these retail spaces or office spaces that, you know, are not being used for whatever reason. And a lot of times in WeWork, I mean, think of how high rent in Midtown Manhattan is, and they were just unable to ever make a strong business model. But I mean, as we were talking before, it's funny because you would totally think that with office spaces closing, companies that are moving to hybrid and remote, that a WeWork-like company should emerge victorious.
And that obviously just isn't the case. They filed for bankruptcy, and this fits into a larger trend that you've reported on of companies going under within the past year. So why are we seeing this pattern?
Yeah, so I think honestly, if you're looking at the highest profile bankruptcies, I mean, you're looking at really, I would say WeWork and FTX are probably the two main ones. FTX and a lot of the other crypto related ones. We saw Celsius, Voyager, Silvergate Capital, which is a bank that was very exposed to crypto. And with that, that's probably not necessarily a pattern of the wider trend. I mean, again.
And was that more of a domino effect? Because was FTX like the main one, and then it just fell from there?
Yeah, and I mean, I think if you're looking, like, I think if I were to say, I mean, the probably the most worrisome bankruptcy in terms of the wider, you know, shift in monetary policy was Silicon Valley Bank and the banking collapse in March. We saw that was pretty contained. There wasn't some big domino effect, but there is some speculation that we could see a lot of companies, you know, probably more akin to WeWork, where it's companies that are banking on high growth without having a very healthy balance sheet in the current moment. And through the first 9 months, this was the busiest year for corporate bankruptcies since 2020. And it was just narrowly behind 2020, and before that was 2010, so since the Great Recession. So it's definitely a pattern. But I think, again, you're going to see investors be it's not we're not quite in that recession, but I think people are being cautious, and you're okay. Like I want to be in solidly healthy companies. I mean, we've seen like with WeWork and SVB, or well, FTX wasn't publicly traded, was once valued at $32 billion. Is that the reminder that stocks can go to zero, and so I think it's that more than anything else of maybe following that common thread of is this one bankruptcy, are there going to be other maybe like real estate bankruptcies or something like that. I think it's more so that it's like, oh wow, like we can't be in these like zombie companies that are burning through cash so quickly.
And is there a correlation between high interest rates? Can we blame the bankruptcies on that too?
Yeah, I mean, I think it's definitely a factor. Again, I think with WeWork, it's kind of with WeWork and some other companies, it's like, a bad company is a bad company. But I think, and especially when you're looking at the wider trend, I mean, there's definitely a strong correlation, and especially companies like WeWork that are focused on higher growth. If you're trying to grow, you're going to be taking on more debt to build out different products or buildings, and then when rates are more expensive, interest payments become more expensive. That's directly coming out of the bottom line. So I mean, you're going to see like there totally are the trickle down effects from higher rates, and it'll be certainly interesting to see. I mean, we've seen the economy stay resilient overall, and especially the stock market. But with I mean, that's one of the top things. I mean, it's just if you're paying more, I mean, think of from a personal perspective, if you're paying for a car loan, it's now 9% instead of 2%. It's like, and then if you're trying to balance your checkbook at the end of the month, and it's like, oh wait, like now I have to pay $800 for the car instead of $600. Like it's just it becomes, higher rates do put another added stress on companies that did not need another stressor.
You said a word, it scares me because I was around alive and well in the 2008 Great Recession. You used the R word there, but you said we saw this trend in 2010 with the high bankruptcies, 2020 with the pandemic, and now in 2023. Is this indicative? Will we see a recession? I know you and I have talked for the past year, and there's always this looming recession, but is that likely as we sit here right now?
Yeah, I mean, this is very buzzwordy, but I think soft landing is certainly, I think that's becoming more of that consensus of we've seen a slowdown, and now we're kind of entering that point that hopefully, it's very quick recovery. There's not going to be any sort of extended pain. I mean, like unemployment's getting up to 10%, like that does not look like that's going to happen, anything like that. But with a soft landing, that doesn't mean that it's boom times. There will be casualties, and we've already seen that. I mean, I think especially the banking crisis in March, I think that's the biggest, I would say. I mean, that's one of the biggest casualties. But it's seeing that with again, I mean, even if we don't necessarily enter a recession quite in the way of like, the Great Recession, I mean, where it's, again, like it's really, really challenging times for everyone, that doesn't mean that there will not be pain. And I think like this is a good way, I mean, of seeing that. I think that, again, I mean, if you're just looking at purely with rates, it makes sense of, okay, like it's going to be weighing on corporate financing costs and weighing on stocks. And we've seen that some, I don't know what the exact latest is, but I mean, still like the S&P, the Dow, it's down around 8% maybe from the peaks before rates were raised. And then also you're going to see it like then the housing market too. I mean, just with mortgage payments, are up. 30-year rates are at their highest level in 2 decades. So I mean, I think it's, again, it's not to, I feel like it's giving a non-committal answer to be like, the soft land, like sort of there's recession. Like I think if we're looking back, 10, 20 years from now, it's probably like, okay, like there's a mild recession. But I think also what's weird too is that, I mean, if you're looking at a lot of these numbers too, is that there was such a sharp slowdown for like only 2 months in 2020. So it's like, I feel like it's kind of like, the lingering effects of that. But Yeah, I don't. It certainly there certainly are evidence of that, recessionary type period.
And we talked about WeWork, we talked about banks going bankrupt, we also talked about crypto exchanges. Can you name the high profile brick and mortar stores that also went under this year?
Yeah, so Party City, there I mentioned Spirit Halloween before. What are the odds I mentioned both of those things right after Halloween too. Rite Aid as well. This isn't brick and mortar, but Diamond Sports Group, which was it was created after the offshoot of Disney's acquisition of much of Fox's assets, and it was formerly Fox Sports Regional Networks, but now they were Bally Sports, and now that went bankrupt. So that's not brick and mortar, but that's also a very high profile one. We've seen it's something like, I think it's like 40 NBA, NHL, and MLB teams. That's where they broadcast their local games. So we've certainly seen some big ones. And then it was last year, Cineworld, which is a British chain and parent company of Regal Cinemas, that went bankrupt as well. So yeah, there've been a lot.
So we see this trend, we see this pattern. What should be our takeaways? What should we, glean from this?
Yeah, I mean, I think, number one, and not to be too much of getting like investing, but I think it's also like, if you're investing in something or just generally like evaluating a company's health for any reason, I mean, it's always cash burn is I feel like that's the number one bad sign. I mean, I think that's more like Warren Buffett would say that. I mean, it's companies' free cash flow, and if you're losing cash, it's really hard to recover. And that's not to say that it's impossible. I mean, we've seen Uber, DraftKings have had really, really strong years after many, many quarters of losses. So not to say it's impossible. And I mean, many of the, early stage companies are going to be losing money. And I think overall, I think it's a good lesson too. Things feel pretty good right now. If you're looking economically or you're looking at the stock market. But it's a good reminder that, this isn't just like boom times that everything's awesome. There's still very much, there are some issues, and it is a pretty challenging environment for, consumers and companies alike with higher borrowing costs.
I think anyone can see that. I mean, consumers, voters I'm talking to, speaking from the political side, they're feeling that squeeze in their pocket. But as interest rates fall, if they do, will we see bankruptcies decline?
Yeah, I think it's fair to expect that. I mean, again, I think there's certainly a correlation there. I mean, of course, you could see kind of a lingering effect of if a company's been having to pay higher interest rates on their debt for several years, then we could see in 2 years from now a company goes bankrupt ultimately because they had to pay higher rates now. I mean, like you could kind of see that accumulation of issues for companies that have to pay higher rates for longer. But yeah, I would very much expect if rates are cut, or I mean, even if, I think so much too is the uncertainty, and I think that's why we've seen over the last week or two there's been a lot more optimism, because it seems like that rates won't get higher than this. I mean, even if they kind of hold steady, it's the devil is better than the possibility of it getting so much worse.
Derek Saul, thanks for your insights. I appreciate you coming on in.
Thank you so much.